Welcome to the deep dive. Today we're really unpacking something huge, I think, something immediate, pervasive.
And maybe often least understood. We're talking about the AI revolution in personal finance.
Exactly. It truly feels like a revolution. And we're grappling with quite a bit of material here. Two main piles, really.
Yeah, that's a good way to put it. On one side, you've got all these sources talking about the new wave of consumer apps, right? Budgeting, savings, the everyday stuff,
The tools that promise to make our daily spending maybe a little less painful.
hopefully. And then on the other side, there's this deep, complex world, the high-stakes stuff, artificial intelligence and actual investment strategy. Big money, big tech.
So our mission here, for you listening, is to sort of synthesize all this. We really want to get to the core question. How does AI fundamentally change how we manage our money?
And how we grow it, too. It's the whole journey, isn't it? From, like, automatically figuring out your grocery budget.
Yeah, maybe optimizing that latte habit.
All the way up to using machine intelligence to handle huge, unpredictable market risks. It's a massive spectrum.
So framing the problem. Traditional money management, let's be honest, it's often tedious.
Oh, absolutely. Spreadsheets, trying to remember due dates, forgetting subscriptions. It's friction, lots of friction. And maybe some emotional decisions thrown in.
Right. So AI comes in promising to replace that friction, make it automated, seamless, predictive even.
That's the promise, like
Right.
having a financial Copilot who's always on, always learning, personalized, predictive, and hopefully less judgmental than we are about our own spending.
A 24/7 Copilot who never sleeps. I like the sound of that. So this deep dive, we're pulling insights from a bunch of financial guides, detailed analyses on investment strategies.
Yeah, covering everything from, the free apps you can download today to the kind of AI tools that big institutions use for trading.
We're aiming to give you that shortcut, that real understanding of this huge shift.
Yeah.
Okay, let's start with where most people feel it first, that AI Copilot for savings and just everyday spending.
This is where AI has really moved beyond just, tracking what you already spent.
Right, the old apps just showed you the damage after the fact.
Exactly. These new tools are trying to tell you where your money should go. And sometimes they even proactively move it for you.
That's the key difference. So what's driving this? It's machine learning, right?
It absolutely is. The power of machine learning in savings.
Mhm.
These aren't static systems running on old rules someone wrote years ago.
They're learning.
Constantly analyzing your spending habits, watching income fluctuations, which is super important for gig workers, by the way,
Oh, good point, yeah.
predicting your cash flow needs, and then automatically implementing saving strategies that are personalized to you. And they adapt
Yeah,
in real time.
that continuous learning. That's what sets them apart from, like, the old Quicken software or something.
Totally. The system learns, okay, you always seem to spend more on eating out Tuesdays, but your utility bill drops in the summer months.
And then it adjusts.
It refines the recommendations. The advice gets smarter, the automatic transfers get smarter, week by week.
Okay, that makes sense. And the evidence is in how they tackle those money leaks, the things we forget about.
Precisely. Where human laziness or just forgetfulness costs us money, that's where the automation really shines.
Okay, classic example. Subscriptions. We've all been there, right? That free trial you forgot.
Still paying for it 6 months later. Yeah. Tools like Rocket Money are really good at this.
How do they do it differently? They don't just list them?
No, it's more active. The AI identifies the recurring charges, figures out how often they hit, flags the ones you probably don't use much.
Based on usage data or just lack of logins?
It can use various signals, yeah. And then, crucially, it helps you cancel them. Often with just a few clicks, it proactively starts the cancellation process.
That's the killer feature. No more hunting through website FAQs.
Exactly. And the savings add up. Our sources suggest users often save, $50, maybe even $100 a month just by plugging those automated leaks.
Wow. That's immediate cash back in your pocket.
Yeah.
Okay, what about something like Clio? That one seems more interactive.
Yeah, Clio emphasizes engagement. It combines the automated savings like roundups on purchases or smart weekly transfers based on predicted cash flow. But it does it with an AI chatbot you actually talk to.
So you text with your budget.
Kind of, yeah. It makes budgeting feel more like a conversation, less like homework. It gives you real-time advice based on your actual spending right now.
Like, hey, slow down on the coffee this week.
Pretty much. Or you've only got $40 left in your fun money category if you want to hit your savings goal. It's immediate, actionable feedback tied directly to your data.
Okay, I can see the appeal there. And AI is also popping up right when we're about to spend money, like with online shopping.
Definitely. Honey is a prime example. It's basically an AI working for you at checkout.
How does that work? It just finds coupon codes?
It scans the web in real time, pulls together all the known codes for that site, tests them automatically, and applies the best one that works, effortlessly.
So you don't have to open 10 tabs searching for codes yourself.
Nope. And the data shows it works. The average user saves something like $126 a year, not because they're actively trying, but because the AI is just doing it in the background. Price tracking, too.
Effortless optimization. I like that. And this goes beyond coupons, right? Into more complex things like travel.
Oh, yeah. Travel planning used to be a nightmare of checking multiple sites constantly.
Tell me about it.
Now you have apps like Hopper. They use machine learning trained on billions of historical flight and hotel prices.
Billions, wow.
Yeah, and they claim 95% accuracy in predicting the best time to book.
So it tells you buy now or wait, the price is likely to drop.
Exactly. And that predictive edge, sources say, could cut your travel costs by 20, maybe even 40%.
40%. That fundamentally changes the game from a gamble to like a calculated decision based on data.
It really does. Takes a lot of the stress out of it.
What's really interesting is seeing AI sneak into places you wouldn't immediately think of, financially speaking, like utility bills. You mentioned grid rewards.
Grid rewards is fascinating. It's predictive modeling driving behavior change for cash.
How?
The AI predicts when the electrical grid in your area is going to be under the most stress peak usage times, basically, based on weather, time of day, industrial load, etc.
Okay.
When a peak event is predicted, it alerts users, hey, maybe turn down the AC for an hour or hold off on running the dishwasher.
And you get paid for doing that.
Yes, you get cash rewards for helping stabilize the grid by reducing your consumption during those critical times.
So the AI turns energy saving into like a micro gig.
Pretty much. It's a win for you, a win for the utility. And it's not trivial money. New York City users averaged $80 a year. Some top earners got up to $500.
Just for timing your appliance used differently based on an AI signal. That's clever.
It is. And even navigation apps like Waze use AI, not just for speed, but for fuel efficiency routes and pointing out the cheapest gas stations nearby.
Those are stealth savings. They add up without you really noticing.
Exactly. Quietly reducing your transportation costs.
Okay, so if AI is this good at micro savings, managing the small stuff, the next logical step is bigger advice, macro-level guidance.
That brings us to the rise of the specialized AI financial advisor. This is moving beyond just budgeting.
And our sources point to a couple of different approaches here.
Yeah, two main paths seem to be emerging. First, you have something like Tendi. It's an AI trained specifically on personal finance knowledge.
Trained on textbooks, regulations, planning strategies.
Exactly. Tendi actually claims it outperforms general AI models like ChatGPT or Claude on the content from the Certified Financial Planner exam.
The CFP exam, that's the gold standard for human advisors, covering investments, retirement, tax planning.
Right. So Tendi claims it knows that stuff really, really well.
Okay, hang on. Knowing the content of the exam, is that the same as giving truly good personalized financial advice? Or is it just really good at recalling rules?
That's the million-dollar question, isn't it? It validates its knowledge base, its understanding of the rules, the scenarios. It provides structure.
Structure, okay.
And Tendi also offers something called the Financial Health Index, FHI. It's a score, 0 to 100.
What does it measure?
Your overall financial picture: income, expenses, savings, investments, debt, net worth. It synthesizes it all into one number to show you where you stand dynamically.
So it's like a credit score, but for your entire financial life. A diagnostic tool using its big knowledge base.
Kind of, yeah. It grades your financial reality. Now, the second path is different. It's more of a hybrid model.
Hybrid. AI plus human.
Exactly. Think of Origin. They offer an AI assistant, they call it Sidekick, for the analysis, the goal tracking, the automated advice. But, and this is key, they also offer optional sessions with actual human certified financial planners.
Ah, so you get the AI speed and data crunching, but you can also talk to a person.
Right, which is probably ideal for really complex stuff, like setting up a trust or dealing with complicated stock options from your job, situations where you want that human nuance and fiduciary responsibility backing up the AI's analysis.
Okay, so moving into the apps themselves.
Yeah.
People manage money differently, right? Different personalities, different needs. The AI has to fit the person, not the other way around.
Absolutely. One size fits all definitely does not work in budgeting. The market reflects that. And while the core budgeting ideas aren't always new, the AI, changes how those philosophies are implemented or enforced.
Okay, let's talk methodologies. Big one. Zero-based budgeting. Apps like YNAB, you need a budget, are famous for this.
Right. The philosophy is simple, really. Every single dollar gets a job before the month starts. Rent, groceries, saving, debt. Everything's assigned. No money left unallocated.
Sounds strict.
It is. YNA really emphasizes this. It's rules-based, and it needs commitment from you. You have to track spending and adjust your category envelopes as you go.
So where does AI fit in if it's so manual?
For modern versions, use smart notifications, projection tools. AI helps nudge you, keep you aware of where you stand against your plan in real time. It enforces the rules digitally.
Got it. And that's different from something like Every Dollar. Also zero-based.
Similar philosophy, but Every Dollar's free version makes you enter everything manually. No automatic bank syncing, so you trade your time for no subscription cost. YNA syncs automatically but costs money.
Trade-offs. Okay, what about the envelope system? Like literally putting cash in envelopes, but digital.
Pretty much. Good Budget is a key app here. You track your income, then allocate funds into virtual envelopes for different spend categories.
Sounds similar to YNA's categories.
It is, but the big differentiator, especially for some users, is security and privacy. Good Budget's free version doesn't require you to link your bank accounts at all.
Ah, so it's pure manual tracking using the app just for organization.
Exactly, which really appeals to people who are, hesitant or just plain unwilling to connect their financial accounts to a third-party app.
That's a specific niche, but an important one. Okay, moving beyond these strict methods, what about just tracking everything? Getting the big picture, especially for investors.
Right. Holistic tracking. That's where Empower shines. You might remember it as personal capital.
Oh, yes.
Empower is really built for investors. Its main superpower is tracking your total net worth.
So it pulls in everything.
Everything. Checking, savings, credit cards, brokerage accounts, loans, mortgages, even things like 529 college savings plans or HSAs. It puts it all on one dashboard.
So you see your entire financial world in real time.
Exactly. The budgeting tools are there, but they're kind of secondary. The focus is that big picture, your overall wealth trajectory.
That consolidated view is powerful for big decisions. Then there are newer players focused on flexibility, maybe a nicer interface, like Monarch Money.
Monarch gets good reviews for being very visual, very customizable. It offers a couple of main ways to budget. There's flex budgeting that's more high level, just tracking fixed versus flexible spending. Less granular. Or you can do traditional category budgeting with specific limits per category.
Options are good.
And Monarch also makes it really easy to share your finances securely with a partner or even with a financial advisor. Built-in collaboration.
That sharing feature is interesting. What about apps designed specifically for couples or people sharing expenses?
Honeydew is the go-to there, designed for couples, roommates, people managing shared money.
How does it handle privacy between partners?
It lets you track both shared accounts and individual accounts. You can split bills easily, chat within the app about expenses, but crucially, your partner only sees the joint accounts you agree to share. Your personal accounts remain private unless you choose otherwise.
That privacy control is vital for couples. Okay, and for the Apple loyalists, the premium users.
Copilot is a name that comes up often. It's iOS only, and it's a premium subscription.
What makes it premium? Better AI.
Apparently, yes. It's known for having a really advanced AI engine specifically for transaction categorization. It learns your spending patterns, the context of your purchases.
So it makes fewer mistakes labeling transactions.
That's the idea. It aims to minimize those annoying manual corrections you often have to do in other apps, which makes your budget data much more accurate over time.
Accuracy is key for trusting the numbers. We also have to touch on business owners. Their needs are totally different. Taxes, cash flow.
Completely different world. QuickBooks is the standard for many small businesses, and they've integrated AI now with something called Intuit Assist.
What does the AI do for a business owner in QuickBooks?
It helps automate things like categorizing expenses correctly, which is huge for taxes, generating invoices, and even predicting cash flow.
maximizing deductions, spotting problems early.
Exactly. It aims to save the owner time on bookkeeping while also making sure they're capturing all eligible tax deductions and maybe identifying inefficiencies in their spending faster than doing it all manually.
Okay, before anyone rushes off to download all these apps, we need to talk practical stuff. Security first and foremost. How safe is connecting your bank accounts?
That's always the #1 concern, and rightly so. Reputable apps use heavy-duty security. We're talking 256-bit encryption, like banks use, biometric logins, fingerprint, Face ID, multi-factor authentication.
Standard stuff these days.
Right.
But how does the linking itself work securely? They don't just store your bank password, do they?
No, absolutely not. Or they shouldn't. Almost all legitimate apps use a secure third-party service, most commonly Plaid, to handle the connection.
Plaid, we hear that name a lot. Can you just quickly explain what Plaid actually does for the listener?
Sure. Plaid acts like a secure go-between. When you connect your bank to a budgeting app via Plaid, you enter your bank login details to Plaid's secure system, not the budgeting apps.
Okay.
Plaid then creates a secure encrypted token that allows the budgeting app to access your transaction data, usually in a read-only way. The app gets the data it needs, but it never actually sees or stores your bank username and password.
Ah, so Plaid holds the keys, not the app itself. That's a crucial security layer.
It is. It massively reduces the risk compared to giving your credentials directly to the app developer. Always look for apps that use Plaid or similar trusted aggregators.
It's a good tip. But even with secure linking, automation isn't perfect, right? What are the downsides people run into?
The biggest frustration is usually technical glitches. Syncing issues, an account stops updating, or updates are delayed.
Yeah, that can mess up your whole budget picture.
Exactly. And mislabeled categories still happen, even with good AI. You buy groceries at Target, and it gets tagged as general merchandise or something.
So you still have to check it, go in and fix things.
Periodically, yes. You still need to audit the system occasionally, which kind of undermines that perfect set-it-and-forget-it dream a little bit. User oversight is still required.
Right. And finally, cost. These aren't all free.
Definitely not. There's a whole spectrum. You've got totally free apps, maybe with ads like Moneyline or Honeydew. Then freemium apps like Rocket Money or Clio. Basic features are free, but the really powerful stuff, like that automated subscription cancellation, costs extra.
You pay for the advanced AI features.
Right. And then you have subscription-only platforms like YNA or Monarch, which might run you, say, $15 a month.
So you have to decide if the features, the time saved, the improved financial habits are worth that monthly fee for you.
Exactly. It's a value calculation.
Okay, we've covered managing the day-to-day, getting your budget tight. Now let's shift gears dramatically. Let's go big into the deep science of AI in investment strategy.
Yeah, this is where things get really complex really fast. We're moving from optimizing your $100 grocery bill to trying to predict, multi-billion-dollar market movements.
It uses the same core ideas though, right? Prediction, automation.
Same principles, yes, but operating on a completely different scale. Different data, different speed, much higher consequences if it goes wrong.
And we need to be clear. This isn't just the old algorithmic trading we've heard about for years.
No, that's a key distinction. Traditional algos basically follow strict, pre-programmed if-then rules. If this stock hits price X, buy Y shares. Very rigid.
So how is modern AI different? It's the learning part again.
It's the learning. Modern investment AI uses advanced machine learning. It doesn't just execute fixed rules, it processes vast amounts of market data in real time and learns from it. It adapts its own strategies as conditions change.
So if there's a sudden market shock, the AI doesn't just freeze, it adjusts.
It can, yes. It might reassess risk, change its view on correlations, shift its strategy almost instantly based on the new data flowing in. That adaptability is key.
And that learning needs fuel. Astronomical amounts of data, I imagine, starting with the data ingestion layer.
That's where it begins. AI systems drink from two main fire hoses of data. First, the easy stuff. Structured data.
Meaning?
Clean, organized numbers. Stock prices, trading volumes, company financials like balance sheets, earnings reports. The stuff human analysts have used for decades.
Okay, standard data. But the real AI advantage comes from the other type, unstructured data.
Absolutely. This is the messy stuff. News articles, social media posts, transcripts of CEO calls, analyst reports, regulatory filings, even the language used in patent applications.
Stuff that isn't easily put in a spreadsheet.
Exactly. AI excels at processing this huge, chaotic stream of text and other non-numeric information, things human teams just can't read and analyze fast enough or at scale.
But the really advanced systems, the institutional ones, they go even further, tapping into weird, novel data sources.
Oh, yeah. This is where it gets really interesting. Finding signals of economic activity before they hit the official reports.
Like what kind of signals?
We're talking analyzing satellite imagery of parking lots or using sensor data from Internet of Things devices in factories to gauge production levels.
Wow.
Tracking the real-time GPS locations of cargo ships to predict supply chain movements. Monitoring power consumption data from utility companies in specific industrial areas.
So if a bunch of factories in one region suddenly start using way more electricity,
That might signal a ramp-up in production before the companies announce anything. These are ground-level, real-world economic indicators that can provide a predictive edge, or alpha.
that ability to pull together all these different, maybe weak signals, that's the magic. That brings us to the pattern recognition layer. You mentioned things like quantum machine learning.
Right. This is where the AI makes sense of all that ingested data. Techniques like quantum machine learning, QML, even using quantum principles on classical computers today can tackle incredibly complex optimization problems.
Faster than regular machine learning.
Potentially much faster for certain types of problems common in finance, like finding subtle, complex correlations across massive, high-dimensional data sets. It's about finding patterns that are effectively invisible to traditional analysis. Computer vision techniques applied to chart patterns or satellite images also fit here.
Finding the signal in the noise, but on a whole different level. Okay, let's make this concrete. You have the semiconductor example. How would AI analyze a chip company differently?
Okay, so a traditional analyst looks at the PE ratio, cash flow, maybe reads the earnings report, standard stuff. An advanced AI system does that, but it also integrates the alternative data. It might see, 1, power consumption data shows their main factory is running hotter than usual. 2, unstructured data analysis picks up an increase in job postings from their key suppliers, specifically for quality control roles.
Okay, interesting signals.
And 3, maybe the QML analysis finds a subtle correlation between the specific technical language used in their recent patents and historical patterns of stock outperformance following similar patent language.
So it connects dots that seem unrelated. Power usage, supplier jobs, patent wording.
Exactly. It sees this confluence of weak signals that, when weighted and combined by the AI, might strongly suggest, say, an unexpected production breakthrough is coming, or maybe a hidden supply chain problem. It catches it before the official news breaks.
That rapid integration and prediction, that's the institutional edge.
That's a big part of it. And this capability feeds into, well, our sources identify about 7 core applications where AI is really changing investment strategy.
Okay, let's walk through them. Application 1.
Analyze and pick stocks. This is the foundation. Synthesizing fundamentals, technicals, alternative data. But crucially, the AI dynamically adjusts the weighting.
What does that mean?
If market uncertainty spikes, the AI might automatically decide, okay, right now, recent price momentum and social media sentiment are more important than the 5-year earnings growth trend. It pivots its focus based on the environment.
Adapting the criteria. Okay, number 2.
Summarize investor sentiment. This goes way beyond just counting positive or negative words.
How so?
It uses contextual sentiment analysis, understanding nuance, sarcasm, implication. For instance, it might analyze the Q&A part of an earnings call. The CEO's prepared remarks might be glowing, but the AI analyzes their tone, their hesitations, their specific word choices during the unscripted Q&A, and detects subtle uncertainty or hedging. That hidden sentiment can be a powerful early warning.
Reading between the lines, but with data. Application 3.
Portfolio management. This is the ongoing maintenance. AI constantly checks if your asset allocation still matches your goals and risk tolerance. If things drift, it automatically triggers optimized rebalancing trades. Keeps the portfolio on track.
Number 4. Personalized investment advice. This sounds like the robo-advisors we discussed, but maybe more advanced.
Much more advanced. It goes way beyond those simple risk questionnaires. Are you aggressive? Conservative?
Right, those feel pretty generic.
The AI looks at your entire financial reality. spending patterns, debt, where you live, and critically, your human capital.
Human capital, you mean?
Right.
My job. How does my job affect my stocks?
Massively. Think about it. If you're a software engineer working in Silicon Valley, a huge chunk of your future earnings potential is already tied to the tech sector, right?
Yeah, my salary, maybe stock options.
Yeah.
It's all tech-linked.
So the AI sees that concentration risk. It recognizes you already have significant exposure to tech through your career. Therefore, it might recommend your investment portfolio should actually hold less tech than it would for someone working in, say, healthcare or consumer goods.
Wow. So it diversifies across your job and your investments.
Yeah.
That's holistic.
It's integrated risk management. Okay, application 5. Evaluate predictive models and risk.
What does that involve?
The AI dynamically maps out how different parts of the financial system are interconnected. It sees the whole ecosystem, not just isolated assets.
Example.
It might model how rising stress in commercial real estate could impact certain regional banks, which in turn could tighten lending to small businesses in their area, eventually affecting consumer spending and hitting specific retail stocks.
Tracing the ripple effect.
Exactly. By mapping these complex cause and effect chains, the AI can identify potential systemic risks early and suggest more effective hedges to protect the portfolio.
Makes sense. Number 6, generate back-testing insights. Testing strategies against history, right? But AI does it smarter.
Yeah, it's not just hitting play on the last 20 years of market data. The AI intelligently weights historical periods based on their relevance to today's conditions.
So if inflation is high now, it focuses on past high inflation periods.
Precisely. It gives more weight to similar regimes in the past and less weight to periods that look nothing like the present. And it goes further. It simulates performance under hypothetical scenarios that haven't happened before, called regime change analysis. Stress testing for the unknown unknowns.
Preparing for things outside historical experience.
Yeah.
Very cool. And the last one, number 7, pull synthetic data. Sounds futuristic.
It kind of is. Synthetic data means artificially generating data sets that mimic the statistical properties of real markets, but aren't actual historical data.
Why would you need fake market data?
Because real market history is surprisingly limited, especially for rare, extreme events. How many truly global financial crises have we had in the last century? How many periods of hyperinflation in developed markets? Not that many.
So your models don't have enough real examples to train on for those extreme events.
Exactly. Your model might look great in normal times, but fall apart in a crisis because it's never seen one like it. By generating thousands of realistic simulated crisis scenarios, a sort of financial multiverse.
Ah, financial multiverse, I like it.
Firms can rigorously stress test their models against these rare but devastating black swan type events. It makes the models much more robust.
Okay, this level of sophistication, it sounds incredibly expensive. Historically, this was just for the big Wall Street players, right?
Absolutely. Reserved for hedge funds, big banks, institutions with the resources. But that's starting to change, albeit slowly. We're seeing a democratization of market insights.
How so?
Well, some firms are launching AI-driven tools for retail investors. Like HDFC Securities has something called SKYMCP. It uses a conversational interface. You can basically chat with it.
So you can just ask it questions.
Yeah, like, what's my portfolio's exposure to volatile sectors right now, given the geopolitical situation? And it can give you a tailored, data-driven answer in plain language. It's bridging that gap, offering insights that used to require an expensive analyst.
Okay, so insights are becoming more accessible. But let's be real, there's still a big divide, isn't there? The tools retail investors can access versus what the institutions have.
Oh, absolutely. A huge divide. The most powerful AI, the stuff analyzing satellite images or using QML, that's still firmly in the institutional camp.
Why? Just cost.
It's cost, yes, massive computing power is needed, but it's also access to proprietary, unique data sources and, frankly, the specialized talent, the PhDs in physics and AI needed to build and run these things. Retail tools generally rely on publicly available data and more standardized analytical models. Still powerful, but not the same league.
So for the average person listening, what are the accessible AI investment tools right now? Where's the entry point?
The most common and accessible starting point is probably the evolution of the AI-powered robo-advisor.
We mentioned those earlier for budgeting help, but they invest too, like Wealthfront, Betterment.
Fidelity Go, SoFi, yes. These platforms have moved beyond just simple rules-based investing. They're using machine learning under the hood to do things better.
Like what specifically?
Things like tax loss harvesting. The AI is much more efficient at scanning your portfolio for opportunities to sell investments at a loss to offset taxable gains elsewhere. It can do it systematically and continuously. Also, more optimized rebalancing and ongoing risk management based on market conditions.
And the cost for these robo-advisors is pretty low, right? Makes them attractive.
Very competitive. Wealthfront, for example, charges like 0.25% of your assets per year as a management fee. Some, like Fidelity Go, are even free below a certain balance, maybe $25,000. They use AI to automate heavily, keep their own costs down, and pass savings to you.
So that's a good option for hands-off investors looking for some AI optimization. What about actual investment products run by AI, like AI-managed ETFs?
Yeah, that's the next step up in direct AI involvement. The Amplify AI-powered equity ETF, ticker AIEQ, is probably the most well-known example.
And how does that work? An AI picks the stocks.
Essentially, yes. It uses sophisticated AI, reportedly IBM Watson, in part to analyze data and select the stocks for the fund, aiming to outperform the market. The idea is the AI spots opportunities human managers might miss.
Okay, the billion-dollar question then. Does it work? Does the AI ETF beat the market?
Well, here's the crucial reality check. Based on the performance data available up to early 2025, AIEQ has generally underperformed its benchmark, like a simple S&P 500 ETF.
Ouch. So the fancy AI fund didn't actually deliver superior returns.
In that period, no. And this is probably the single most important takeaway about AI and investing right now. It's an incredibly powerful tool for analysis, but it is absolutely not a guarantee of better performance.
The market's still messy and unpredictable, even for a smart machine.
Exactly. AI struggles with true novelty, with black swan events it wasn't trained on, just like humans do. It's a tool, not a crystal ball.
That's a vital dose of realism.
Okay, final accessible tool. Just using the everyday large language models, LLMs, ChatGPT, Gemini, etc., for research.
Yes, and this is maybe the most democratizing aspect. These LLMs, many available for free or low cost, are fantastic research assistants.
How would an investor use them?
You can copy and paste huge, dense documents, think SEC filings, long earnings, call transcripts, and ask the LLM to summarize the key points, extract the main risk factors, or just explain complex financial terms in simple language.
So it helps you digest complex information faster.
Massively faster.
Yeah.
It lowers the barrier to doing initial research and understanding companies or market trends.
And it's a big but, you can't just trust what they tell you, right? They're not financial advisors.
Absolutely not. They must be treated as assistants, never as decision makers. The risk of getting outdated information, or worse, the AI simply making stuff up, those infamous hallucinations.
Right, where it sounds confident but is totally wrong. That risk is very high, especially with financial data that changes constantly. Any specific number, fact, or claim from an LM needs to be double-checked against a reliable primary source. Verification is non-negotiable.
Treat it like a smart intern. Helpful for gathering info, but you need to check their work carefully.
Excellent analogy.
Okay, this complexity, the hype around AI, it seems like perfect territory for scammers, unfortunately.
It really is. The perception that AI is this incredibly complex, almost magical technology that guarantees results. Fraudsters are exploiting that perception heavily.
And regulators are worried.
Very worried. The SEC, FINRA, they're issuing active warnings about AI-related investment scams.
What do these scams typically look like? What should people watch out for?
The most common pitch involves some unregistered platform claiming they have a proprietary AI trading system, usually secret, of course.
Proprietary secret. Red flags already.
Big red flags. And they'll promise ridiculous returns. Outsized, guaranteed, can't lose that kind of language. Any guarantee of high returns in investing is almost certainly a scam. Markets involve risk, period.
So the combination of secrecy, our magic AI, and certainty, guaranteed profits, is the hook.
Exactly. It plays on both the allure of advanced tech and the desire for easy money.
And the technology itself is now being used to make scams more convincing.
Yes, that's the scary part. We're seeing AI-enabled technology scams. Fraudsters using deepfake video.
AI-generated fake video.
Yeah, or synthesized audio to convincingly impersonate legitimate people like a famous CEO or a well-known financial commentator. They use these fakes to build credibility for their fraudulent scheme.
Wow, that makes it much harder to spot fakes. So how do people protect themselves? The basic advice still holds.
It's more important than ever. First, always verify registration. Is the platform, is the advisor registered with the SEC or FinNRO or your relevant state regulator? Check their official databases. It takes minutes.
If they're not registered, walk away.
Immediately. Second, extreme skepticism is your best friend. Be incredibly wary of any promise of guaranteed returns or returns that sound way too good to be true compared to normal market performance.
If it sounds too good to be true.
It almost certainly is. And remember the reality check. Legitimate AI is a tool to enhance analysis, improve efficiency, maybe manage risk better. It does not eliminate risk, and it does not guarantee profits. Anyone claiming otherwise is likely trying to scam you. Hashtag outro.
All right, we have covered a lot of ground today. It feels like we journeyed from, the kitchen table budget spreadsheet right up to the high-frequency trading floors.
It's a huge spectrum. We started with that immediate practical stuff, the personalized AI Copilot helping you save automatically.
Right. Tools like Rocket Money, finding those forgotten subscriptions, Honey grabbing discounts, Hopper telling you the perfect time to book a flight. Tangible benefits.
And then we really jumped into the deep end, the complex, data-drenched world of institutional AI in investing.
Where systems are analyzing cargo ship movements, factoring your career path into your portfolio risk, using contextual sentiment analysis to read between the lines of CEO statements.
And even generating synthetic market data to prepare for crises that haven't happened yet. Mind-bending stuff.
So if there's one thread connecting these two worlds, what's the bottom line for our listeners?
The bottom line, I think, is that AI-driven tools are fundamentally changing financial well-being. They do this through continuous learning and unprecedented personalization. They're replacing some of that old friction with automated adaptive discipline.
Making it easier to do the right thing, financially speaking.
Potentially, yes. But, and this is the crucial, but AI is not magic. It's not a golden ticket.
As we saw with the AI ETF example.
Exactly. It's not infallible. It doesn't guarantee you'll beat the market or never make a mistake. It should always be seen as a tool to complement human judgment, financial literacy, and common sense. Never a replacement for them.
The AI gives you powerful insights, maybe automates good habits, but you still need to understand the why. You still need to be engaged with your own money.
You got it. The tools enhance your capability, but you're still the pilot.
Okay, that leads us to our final, maybe provocative thought for you, the listener, to mull over.
Let's hear it.
We've seen today that advanced AI can analyze your very specific spending habits, your career path, even local economic trends to create deeply personalized investment advice. So, if an AI financial advisor crunching all that data actually understands your unique risk tolerance better than your own gut feeling does our own human intuition become a liability? Does intuition become just another risk factor that the AI needs to help us manage out of our own portfolios?
Is intuition a bug or a feature when the AI knows you better than you know yourself? That's a deep one to end on.